Good morning, ladies and gentlemen. Well, by my calculations, we are in the 50s or very low 60s. So we are in risk on. It might last a while because of the bonds. And I've done you saw what I did the video on Friday about where the bonds are going. So I will go into less detail about the bonds, and I will also include a link to that video so you can watch it again. But I think that we are beginning to get a turn in the bonds, which is boosting all asset classes. And what I want to do here is see which part of the yield curve is the most attractive and what is most likely to happen up to year end, because I think the recession starts in 2023 and that will completely change the shape of the yield curve. If we start with the bond yield curve, current versus a week ago, you will see that basically we dropped around 23 basis points in the twos. We dropped slightly more in the threes and the fives, and least of all in the tens, T-bonds, and in the ultras. The flattening has been, it started. Let's put it that way. Now, we will continue to get this kind of big moves, 20 basis points, 25 basis points up or down on the week with each set of data that we get. What is the yield curve saying? This part of the yield curve is saying we are going to get a recession at some stage. Do we know when? Do we know whether it's going to impact the twos most, or the threes, or the fives? No, we don't know. We don't know the timing. But what the market is saying, it is coming. I don't know whether it's going to be within the twos, but I'm pretty confident it's going to be within the threes, and I'm almost 100% confident it's going to happen within the fives. So you get people buying a mixture of twos, threes, and fives, and basically producing this kink. On the way back, if we get bad data, the twos are going to move less than the threes and the fives. So we're going to go back to this straight line. But this market is basically telling you that they are pretty damn convinced that at some stage the Fed is going to have to lower rates. We don't yet know what the ultimate terminal is, but the market is beginning to very much doubt that it's going to be above 5%. So that is what this yield curve is saying. Naturally, it could change over the course of the next week or two, but we will need data for that. So the market is now very much data dependent and in the starting blocks for a reverse of everything that's been happening so far this year. One of the possibilities is that inflation becomes sticky and stays above 2.5%, something like that, 2.5%, 3%, in which case the twos will go down towards the 2.5%, and you'll get a minimal movement in the 30s, and you get a positive yield curve with the twos, the threes, and the fives all down below 3.5%, and the 30s not moving very much. I think that that is probably the favored kind of yield curve that we get in the middle of 2023, but 1 week at a time. And what I've been saying about the yield curve in the bonds is actually reflected pretty damn well in the Eurodollars and the Eurodollar spreads. Now this is EDZ22, so the one that's going to be expiring next month. What is interesting to me, and I pointed it out to you last week, is that we are now actually higher than we were when Powell spoke in the presser. Let's see if I can enlarge this for you. this is the day of the presser, okay? And now we are a good 12 to 15 higher than we were then. That basically says that the short end of the curve no longer believes Powell, and that we are going to be higher for longer, and that we are going to have terminal rates above 5%. Now we're starting to discount terminal rates below 5%. If we go out to EDZ23, and I'll enlarge this one for you as well, but I'll go a bit further out. This is the day of the presser, and now we are a good, nearly 40 basis points better than we were. So we are looking for cuts by December 23, and if we go to December 24, we are now basically where we were in June, the low of June. So basically we've done nothing for 3 months. And we are looking to basically get to these very long-term moving averages. Probably we will try to do much the same as we did in this is August, early August of this year, when we touched the very long-term downtrend line and then come back off it. All this is saying that basically the market is pretty damn convinced that at some stage next year they're going to have to start cutting. And the question is how much they cut, when the exact that time is, but the market is definitely going for cuts next year. The way the markets don't work is they don't discount nothing happening for the best part of a year. That's definitely not what they do. The market's always looking to discount what could happen. And to me, the path of least resistance from now on, whether it's from here or from a little bit lower down in a few days' time, but the path of least resistance over the course of the next quarter, 2 quarters, is going to go and test these levels up here again. Looking for cuts down towards the 3% area, sometimes in 2023 or 2024. So let's do a quick rundown of the individual tenures and the yield curve and the individual bits of the yield curve. What to me is interesting is that all these charts are developing some sort of head and shoulders. Okay, some sort. I'm not going to say that they're precise. I'm not going to say they happen now, but they are beginning to develop them. It might take time, and it certainly is going to take more data, i.e. another 2-3 CPIs and unemployments, non-farm payrolls. But they're beginning to develop them, and therefore you have to be cognizant of that. These are the twos. Have we broken through 425, 426? No, because we don't have enough data yet. But I think that all the moves back up are going to be contained. You are no longer going to see these 30, 40, 50% moves on the way up. You're going to see 10, 15, maximum 20s, and then the market will be looking to come down again. So the volatility, the very short end on the upside, I think is going to be muted. But the volatility on the downside, i.e. if we get better data, I think is going to be greater. If we look at the fives, we've broken through 406, and at some stage, could we go back to it? Absolutely. But at some stage, we're looking to test this 370 area and see what we do there. And that is also very visible in the tens. I think at some stage we test this 370 area. And if we break it, we are going to go and test this 347. The 30s, least of all are they looking ready to drop, which makes sense because people are getting out of their flatteners. I think the 30s are going to have a very tough time coming down through 394. And what do we close at? 404. So that's like 10 basis points. The interesting bits of the yield curve are basically the 530s. And to me, it's likely that we are developing this right shoulder, which might take 6 months. It might take a good while. This took from, what is it, April to September. So something similar in length could happen on this side. But what is absolutely certain is that when recessions strike, 530s move like shit off a shovel. And you can see that if I move that to a 1 month view. This is basically what happened in 2000. And you can see how far they go. Typically they go to something like 150 to 170 basis points of inversion. Do I think that that is likely to happen now? Not with the stickiness of the inflation we have now, but certainly down to something like 120. This kind of area. There you go, this 102. So that is what I think is very, very possible. And I think that any move back up to 12, the risk reward is very much to the downside. So I think that over the course of the next 6 months, we develop that right shoulder. Let's go back to the 1 day. We develop that right shoulder and we are looking for moves which take us down to about here, around the 100 basis points mark. Europe looks completely different. Still, what you have to remember is that the ECB is very much behind the Fed, and different, a different situation exists in Europe. Plus, they're far, far below the yields of the US, right? So this is the Schatz. This is not particularly bullish. The odds are that we go and test even higher. And if I change that to a monthly, you will see basically where we are. We're in this kind of period. We could easily still see 268, 270. Why? Well, it's obvious. The ECB is still in a tightening mode. We still have this contract completely mispriced, whether it's because of scarcity of collateral or whatever. Let's not get into the reasons. But there is no way that the terminal rate in Europe is going to be that much lower than in the US. And also, there is no way that if inflation becomes sticky in the US, i.e. it doesn't go below 2.5 or 3% for a very, very long time, that it's going to be, a bed of roses in Europe. The inflation rate now is higher in Europe, and therefore why, if there is stickiness of inflation, and that's a worldwide phenomenon, it's not something that's going to be just in the US, then why would twos be the thing that you buy in Europe? I mean, makes absolutely no sense. Because even if the US starts easing, why should that have any impact or relevance, rather, for Europe? It just shouldn't. So this yield curve should flatten and invert. And if you look at the fives, and we'll go to a daily, that also might be developing some kind of a head and shoulders, or starting to, and certainly the bunds, but that is going to now, I would have thought, almost certainly lag behind the moves in the US. I just can't see Europe now being a leader. I can see the US being a leader, not Europe. So this is not looking nearly as bullish to me as the US is, and this is the one that basically should be your guide. It is so perfect. Did it touch 247 just about, and on Friday it gave up everything it gained on Thursday, the whole thing. That tells me that this level is so important until we break it and close below, in which case we probably could get a good move down to 208. You just forget about being long of Europe. There is no point. I've got this line here at 271. I think the risk reward at 271 is for a slight fall, but it's nowhere near as compelling an argument as the argument in the US. And if you have a look at what is happening in 210s, here we are. We are going for, we're at 0, so we're going just like the in the US. You had this big move in the 210s from 20-30 basis points all the way to -60, -70. This is what is happening in Europe, and it makes sense. These levels never made sense to me. These levels, and we will go to a monthly chart so you can see, these levels going to, 50, 60, 30 to start off with over the course of the next few weeks makes sense, which basically means forget about buying shats. Never buy shats. Just look for levels to sell shats. And you can trade the bunds off what the 10-year OAT is doing, unless the 10-year OAT breaks this. Let's go back to it, and on the daily, unless the 10-year OAT breaks 247, you are not really looking to be buying a huge amount of bunds. So what does that mean for the yield curves across US against Germany? Well, finally, what I've been talking about for a long time is happening. 255 now rejected, I think, absolutely, no chance. So now we're looking for any kind of move back towards 238 to give us eventually 193. And you can see a great big head and shoulders here developing, right? And if you look at the 5s, much the same thing, but I think that stops somewhere around 174. And if you look at the 10s, told you 196, what risk reward that was, and we're now at 169. Okay, so if we get back up to 182, you slam it because you're looking for 152, again. And this is going to be, over the course of the next year, the big one, I think. I'm always early into trades, but rarely long-term wrong. To me, this is the one that's going to move, very much to the downside eventually. And when it breaks, it's going to go to these levels. It's going to go to 50 basis points. So the differential in 10s is going to be something like 50 basis points. And in the 2s, it's going to come down to here. It's going to come down towards the 40, 50 basis points. To me, it's this differential will continue to come in over the course of the next year. The dollar is finally starting to make some sense as those differentials move. The dollar is moving too, which basically means that we're out of the fear and panic stage and we are in a more sensible stage. Could we be developing a head and shoulders in the dollar as well? Absolutely. Which basically means it's going to take some time. Now, would a bounce off 106.25 make sense, say up towards this 109 area, 109.29 on the dailies? Yeah, absolutely. I think it's going to be very hard to break the 200-day moving average, which is so strong on the upside, or break it convincingly on the first attempt. I think it's far more likely that if we do that, if we try the 200-day moving average or slightly lower, we have a reaction at some stage back up towards 109.29, but that would be a right-hand shoulder kind of thing, looking to break it later on and come back down towards this 102 area. If we have a look at what that implies, it's obvious that Euro USD is very much, you're looking for a test of this 104.60-ish area, maybe slightly higher to stop people out, above the 200-day towards the 106. And then this is where the the Bollinger Bands and the moving averages all are. And then you come back down towards 102 something, develop some kind of a right-hand shoulder, and then you can go. Would make sense and would tie in with what the bonds are saying, that they are going to develop some kind of a right-hand shoulder. So it's going to take time. It's going to take retracements. It's going to take tomfoolery, stopping people out both ways on the upside and the downside. But I think odds are that we are starting to develop into a turn for the US dollar. And gold finally did what it should have done a couple of weeks ago. But it's quite likely that it now leads and confirms the two things that I've been saying to you, i.e. one, that the yield curve starts going disinverting, and B, that we do some kind of a right-hand shoulder on the US dollar as well the individual tenures of the bonds, and then then gold can lead again. What would that mean on a weekly basis? Well, it would mean something like this developing here, and then going. So maybe it's best seen on a daily chart. To me, 107.64 is an extremely important level, and every time it goes through it, it goes to at least 108.30. So let's say that we get to 108.30, just like, DXY could try to do the 200-day moving average, and this spikes the 200-day moving average, stops a whole load of people out, and then comes back to something like here, 1730-ish, and develops some kind of a right-hand shoulder as well here. Everything needs time now. The moving averages are still pointing down, so there will be reactions lower. But to me, it's all beginning to say the same thing, i.e. the differentials between the US and Germany and Europe are definitely topping. DXY is topping. Gold is bottoming. And it's all leading me to the same conclusion, that at some stage In 2023, we get a recession, and that boosts the prices of bonds, boosts the prices of currency, boosts the prices of gold. To me, the timing of some sort of a recessionary expectation by the market has to come from gold DBC. Okay, so what has happened in gold DBC? We came back to this line where where were we when I said that this is where I start favoring gold to DBC? We're somewhere around here. And now what we have to do is finally break this moving average, which is down here. I don't think it's going to be quick. This is a daily chart, but it could easily take 2, 3, 4 months for that to happen. And once we start breaking above that line, that would mean that the market is buying more gold than it is commodities. And since DBC is very much oil, it would mean that there is demand destruction, which is reflected in the bonds, which therefore reflected in the price of gold and in the US dollar, because you need less US dollars to buy the oil. So when this starts turning and going back up, we're not there yet, right? We're right on top of the 200-day descending moving average, which possibly means that we still go sideways. But when that starts breaking up, that will be the timing to start really buying gold against DBC, and we could get something like, really a 20-30% move. Certainly, why not up to here? That kind of level. So 950 from 630, 30% plus. That is the kind of move that you're going to see. And if we look at DBC, what that would imply, well, it just keeps on failing at this 26.93 level. It just cannot get up there. And you can see what happens when it can't get above 26.93. Okay, this is all the way back to 2013, 2014. It tries it, goes sideways, eventually goes, and that is recession, right? And recession means that nobody is buying oil, or you need a lot less oil, etc., and metals, industrial metals, etc., etc., etc. So is that going to happen now? I have absolutely no idea. It's not going to happen very quickly. I'm pretty damn sure about that. But what I'm trying to say to you is that I'm looking for that, for this chart to give me the timing of when the recession comes. And it probably won't be for many months. I've included in the bias tables and the support levels this article, which I think is correct. I think Ed Yardeni is very good, and he basically argues that the multiples may have bottomed at 15. And I think he is absolutely correct. And if we move to the Blue Angels, you will see that basically it's going to be very, very difficult for the time being to break through the 15 times multiples, especially given my view of what the yield curve is going to do and what the individual tenures are going to do. So if you don't get much higher yields than 4.25 on 30s, it's very, very unlikely that you get below 15 times multiples. What can come down, if it's not the P, it's the E. The E can still come down quite significantly, and just because we don't break, just because bonds don't go much higher in yield, that does not mean that the 30-year is going to come that much down in yield, as I've argued earlier. So to me, this times 18 of these very inflated current earning expectations is going to be as much of a top as you can possibly hope to get, which would be somewhere around 4,100 something, maybe 4,200. We'll look at it in more detail in a moment, but you can see what a almost historic risk reward level you get at that level, because these are still 230 plus dollars of earnings expectations. If we get if I'm correct and we get a recession early next year, absolutely no way do we have these Blue Angels at these levels. They'll be at 200. And 200 even times 18 is 3,600, right? So this can come down. Even if bonds are supportive, this can come down a long way still. What about equities in absolute terms? This is a monthly chart. Let's enlarge it. Right, we're right at the resistance of the moving averages that it likes to bounce to. What I would love to see is a move to 41.81. Coupled with what I've just told you about the Blue Angels and expectations, this to me would be a fantastic risk reward level to try and get short. And I don't mean short for the short term. I mean a 6-month put spread, something like 4,200, 3,500. That's what I think of that one. If we look at instead of what what the weeklies are saying, you can see that really between 39.43 and 42.47, we don't have a lot of resistance. We might have some here, 41.50, and that is where this moving average is coming in. So everything is, to me, is indicating that they're going to squeeze this market to something like, or even try and close this gap at 42.30. But that is neither here nor there. What I'm trying to say is that the volatility in this is between these levels is quite high, i.e. the market moves quite a bit. So it's quite likely that you get big squeezes, and the support, I think, is now going to be absolutely rock solid between 38.60 and 39.40. Certainly for the next couple of weeks. So I think squeezes up to this kind of level, 41.60, more likely than not, which indicates to me that the market is going to, there's going to be FOMO, there's going to be people saying, seasonality, they're all going to buy it, get to that kind of level, and then they pull the rug. I'm not really in the mood to start fighting it until this kind of level. It all makes sense to me that they try to get it there. What's that? Another 160 points, so that's 5%. Why not? Why not? Because I think NQ is actually going to be quite supportive here. And do I think that NQ can get up to this level, 12,300? Yes, I do. I think it can quite easily. This kind of level is probably more likely than not. You can see how oversold it is now on the monthlies, and where were the highs here? 12,150, and these bottoms here were 12,230. Spike it a little bit, get to 12,300 without any problem. So that is what I think is quite possible. And if we go to the 190-minute chart, would it really surprise anyone if we saw 12,400? Well, not really, right? try to close these all these gaps here. We have gaps all the way between 12,400 and 12,700. Trade in this kind of area again, get everyone long and bullish, and then next year. There isn't a single risk indicator which at the moment is bearish. So this is SPY over IEF, even against, the 5, 6, 7 year maturity. SPY is doing quite well. Could it be developing a very long-term head and shoulders? Yes, it could be, but at the moment it's certainly not a bearish stance here. SPY is holding its own very much. It's holding its own and doing better against TLT, right? I mean, this is just in a trend. It's going higher. SPY XLY last week, boom, so it's correcting, okay? This is correcting too, therefore it's not bearish. When XLY falls, I think it's going to take next year until XLY starts or SPY starts outperforming XLY again. Even the Qs against TLT, I mean, look at it. I mean, the Qs should be as weak as hell, and they're not. They're pointing to higher prices relative to bonds. If I think bonds are not going to fall very much or rise very much in yield, I have to expect the Qs to go and test the highs. RCD over RHS, the one that has, that's equal weight, right, in defensive or consumer durables against consumer staples. It's pointing, it's breaking upwards. It's pointing to risk on. SOX over FXY, strong. XLP, XLY, boom, at best that is going to consolidate here. SPY over PSCD, breaking down, and that to me is amazing. Okay, it might not really break all that much, but it's certainly not going up. For risk off, you need this to go up. There is no way that small retailers and stuff like that should be stable against SPY if we are about to fall into a recession. What this says is that it's not going to happen yet, but it's another, risk on. SPY over IWM, not bearish. QQQ over IWM, boom, great big, can it even come and trade up here? Yes, it can. And this one, ITOT over iGovernment, which is the totality of the stock market against the totality of the bond market, it's in an uptrend, right? Short-term uptrend. Could it be doing a topping pattern and then next year it comes down? Absolutely could be. We will know when that happens because it'll break this level. All I'm trying to say is that for the next 2, 3, 4 weeks, whatever it happens to be, we are not in risk off as yet. And this leads me to believe that my idea is that we're going to be developing some kind of a long-term right-hand shoulder in the yield curve, in the 530s and stuff like that, is probably right, and that we're going to need much more time before the market is ready to accept a recession or the depth of a recession in 2023, and therefore start moving the yield curve, start moving all these risk spreads and everything else. I forgot when I showed you this chart, is it a week ago or 2 weeks ago? SPY over FEZ. Spreads don't lie. We are back to where we were at the beginning of the year, within 1%, which is quite amazing in a year where the dollar has been, people have been screaming that the dollar's been appreciating so much, and also that Europe is going to go to hell in a handbasket. Well, the stock market valuations of the two are pretty much identical where they were at the beginning of the year, even taking into account what the dollar has done. Has this now gone? I mean, and this is what told me that the dollar was likely to remain weak next week, whenever I posted it. Could we now bounce a bit? Yes. I mean, absolutely. I mean, these straight moves tend to be corrected. This is this is almost a 20% move that we've had in 3 weeks. And this is making another, could it make the right hand shoulder? Absolutely. So that also tells me that we are not in risk off, that we are unlikely to get a very sharp move down in the S&Ps, because really you would need to have a bigger move down in the European market if you're going to get a big move down in the S&Ps, i.e. the timing is not right. You're more likely to go back to these levels, right, and start developing this right-hand shoulder. And that to me says that the S&Ps are going to remain bid over the course of the short term. So you're looking to buy dips for a trade. It'll only be when we get to those ridiculous levels around 4,200 that I think you could have retraced some of this, be here, fill some gaps, and then you're ready to start tipping over again. But this to me says next week the dollar shouldn't really go very far. The S&Ps should outperform the stocks by a little bit. And the stocks per se are at very, very, very interesting levels. Now 38.43 did not hold it, but it's through the weekly Bollinger Band. Coupled with what the chart I just showed you of SPY FEZ, that tells me that this is going to go nowhere next week, while the SPOOs try to do a little bit better, or this retraces a little bit and the SPOOs don't, or far less. That's what I'm trying to say. Could it get up to 39.95? I think it's going to be difficult. I think it's going to take a lot of time, and we could be at 39.95 in the FEs, in the stocks, coupled with that 41.80 level, or whatever, the 4200-ish level in the SPOOs. That could be a possibility, but I cannot be bullish of this one, because it's done a straight line up for was this 1, 2, 3, 4, 5, 6 weeks up? Could it go 7? Could it go 8? Yeah, absolutely. But at some stage that retraces, much like it retraced here. The only question is, where is the top? 39.95 now becomes my absolute line in the sand. I think that would be amazing if it went through there, which gives you not a bad risk reward even here, right? Because you're talking about 38.68 to 39.95. To me, this is much more likely to go, like this, and the SPOOs to do slightly better against it. Well, volatility has not failed us. It's giving us the target. To me, the target is the gap fill down to 2060. Until it gets down there and it's filled that, the risk reward is still for higher prices in the SPOOs. And down there it starts very much turning. Let's have a look at this one here. Here is here's the 2060 area. It'll then be below the slowly rising 200 period of the weekly moving average. It will have filled all these gaps. And when it fills the gaps, it tends to come down to this kind of level. You can see 1930s. And that would basically say that what I was saying earlier, that the S&P could even get to 4180, 4200, whatever it is an absolute possibility. Think how wonderful it would be if everybody got stopped out of volatility here at 18, market went down to 17, and then boom, over the course of the next couple of months, it goes back up over 30. That is basically what the market is saying. It's in risk on. There is absolutely no reason to look for big falls in the stock market at the moment. The bonds are supportive, the yield curve is supportive. It's going to take a long time before people decide that the reason why those markets are supportive is because they're starting to discount a recession and Fed cuts sometime in 2023 or 2024. As I show you, they don't know when it's going to be, but they're pretty convinced that that's when it happens. And I've never seen a recession which has higher stock prices just because bonds are doing better. With that, I've updated all the levels and I've put in here the links to my Friday videos for those who didn't look at it, who didn't see it, and also the daily quick takes that I agree with. I think the multiples have bottomed, but that doesn't mean a lot for the absolute level of S&Ps. All the levels are updated. Look forward to tweeting to you on Monday. Have a wonderful weekend.